Hello, everybody. This is Alan Ellman, the Blue Collar Investor, welcoming you to this video presentation titled Portfolio Overwriting, Covered Call Writing Our Long-Term Buy and Hold Portfolios. This video will detail a specific covered call writing-like strategy that applies to those of us who have stocks or ETFs over a long time frame, probably in non-sheltered accounts, generally bearing dividends, and we would like to generate additional income leveraging these securities, but trying to avoid exercise of the options and having those shares sold. So it's a specific form of covered call writing. Let's get started by defining the term covered call writing. Now, with covered call writing, we are on the sell side of options. We first buy a stock or an exchange traded fund, ETF, which puts us in a covered or protected position. We know our cost basis. Once we own the underlying securities, we then are free to sell the call option, agreeing to sell our shares at the strike price that we determine by the expiration date that we determine. Now, once we do that, we then have undertaken a contractual obligation to sell our shares at the parameters that we decided on, and we then collect the premium. We get paid. And that's how the process starts, by getting paid. Let's now go to a preview example of how covered call writing works. And this is actually more for a traditional form of covered call writing, and then later on, we'll get into the specifics of portfolio overwriting. In this hypothetical, we're going to purchase 100 shares of company XYZ at $48 per share. The reason I use 100 shares is because for every one option contract we sell, we must first own 100 shares of that underlying security. So our cost basis then is $4,800, 48 times 100 per contract. We are then free to sell the option. So we're selling some unknown person the right, but not the obligation to buy our shares from us at a price that we determine. In this case, we're going to use $50 at any time of contract expiration, and we're going to use a 1-month contract. Now, we are getting paid to undertake this contractual obligation to sell our shares at $50 anytime over the next 1 month. A typical premium would be $1.50 per share, or $150 for the contract. And this is a typical return. If the underlying was more volatile, we would get a higher return. If it was less volatile, we get a lower return. The greater the volatility, the greater the premium, but the greater the risk. Now, $150 on a cost basis of $4,800 represents a 3.1% 1-month return. And that's our initial return. It's not our final return. Final return could be higher, it could be lower. But 3.1% a month represents a 37% annualized return. Now, setting aside exit strategies, which are beyond the scope of this video, there are two possible major outcomes. In the first, if the price of the stock does not move above the agreed upon $50 sale price, our shares will not be purchased. Why would the option buyer exercise the option and buy our shares for $50 when they're trading at market at some lower price? So the option expires worthless. We keep the $150, and we have a realized 3.1% profit on the option side of this trade. Since we still own the shares, we're then free to sell another option in the next contract cycle. Now, the second possible major outcome is at the end of the contract, the price of the stock has moved up beyond the $50 agreed upon sales price, and we take no action to close that short call, and our shares will be purchased at $50. And that will happen the day after expiration, the Saturday after expiration, Friday. We go into our brokerage account, log in, and we see that the shares aren't there anymore. And then we look at our cash account, we see we have all this cash now in our account. So if that happens, we generated $150 to start on the sale of the option, another $200 on the sale of the stock, 48 to 50 times 100, Total realized profit, $350 on a cost basis of $4,800 represents a 7.3% 1-month return. So when we sell this type of option, we're agreeing to sell our shares at a higher price than current market value. It gives us the opportunity for two income streams, one from the option premium and the other from share appreciation. Now we're going to do a couple of definitions as it applies to options and covered call writing. Not a lot, but it'll build a foundation from which the remainder of this video will be based. So let's first define the term option. Well, an option is a made-up thing. It's a contract that gives the holder or buyer of that option the right to buy or sell 100 shares of stock at the strike price by the expiration date. Now, call option, which is what we're dealing with in this video, gives the buyer the right to purchase 100 shares of stock at the strike price. A put option is the opposite of a call option. It gives the holder or buyer of that option the right to sell 100 shares of stock at a specified price. So when we sell a covered call, we're agreeing to sell our shares at the strike price by the expiration date. And whether or not that contract is going to be exercised is in the hands of the option buyer, not us. Now we have four more definitions here on the call strike as it relates to the current market value of the stock. You see four bullets here, and this is known as the moneyness of the option. The first bullet is the at the money strike, and that's where the price of the stock is identical to the strike price. So if a stock is trading at 30, and we sell the 30 call, agreeing to sell it at 30, that's known as an at-the-money strike. Now, very closely related to at the money is the near the money strike. And that's where the strike price is close to, but not exactly the same as the price of the stock. An example would be a stock trading at $29.95, and we sell the 30 call option. So it's not precisely the same, but it's darn close. And that's referred to as near the money. Now, the in the money strike, which is rarely used by covered call writers outside of the BCI community, but we use it a lot, that's where the strike price is actually lower than the stock price. So an example would be stock is trading at 32 and we sell the 30 call, agreeing to sell our shares at $30. And we're going to break this down in the next slide, and you'll see that the premium will actually compensate us for the $2 a share we're going to lose on the sale of the stock, plus a little bit more. So stay tuned for the next slide on that one. Now, the out of the money strike, which is what I used in the preview example, and that's where the strike price is higher than the price of the stock. So we're agreeing to sell our shares at a higher price than we entered the covered call trade. So another example would be a stock trading at 28, and we agree to sell it for 30. Now, this is the last slide of definitions. We talk about the option value, the total premium that we receive as it relates to the price of the stock. Now, if you look at the bottom of the screenshot here, you see an equation that says the premium, that's how much we collect when we sell a covered call, consists of intrinsic value plus time value. However, intrinsic value only applies to the in the money strike. And so at the money strikes, buy a stock at 30, agree to sell it at 30, and out of the money strikes, buy a stock at 28 and agree to sell it for 30, are all time value. No intrinsic value component at all. However, in the money strikes do have an intrinsic value component. So back to the example I showed in the last slide. If we buy a stock at 32 and sell the 30 in the money call option and we generate $3, we can't count that entire $3 as profit because we're losing $2 on the sale of the stock, right? So if we get $3, of that $3, $2 is intrinsic value. The amount at the 30 strike is lower than current market value. That leaves $1 of time value, and that $1 is our actual initial time value profit. So remember the equation. Premium consists of intrinsic value plus time value. Now let's get to the option change so we could start making money, because that's why we're all here. Now we're going to use a real-life example with InMode Limited, trading on the NASDAQ under the ticker INMD. And at the time that I made this screenshot earlier this year, in mode was trading at 48.17, and this is for a 6-week expiration. So at 48.17, we're going to look at the in the money, lower than current market value, 45 strike, the near the money, 50 strike, slightly out of the money, and the deeper out of the money, 55 strike. Now we look at the bid column. We always sell at the bid and buy at the ask. And the bid column shows premiums of 610, 380, and 210. Now that 610, you could see the ask is 690. So there is a way to negotiate a better price with the market makers, but that's beyond the scope of this presentation, but it is in the material that is available on our website. But just remember these 3 bid prices. What we're going to do now is we're going to feed them in to our trade management calculator. And I've kind of broken that up into 3 sections on this screenshot. And the trade management calculator is a one-of-its-kind spreadsheet found nowhere else in the world that will allow us to enter our covered call or put selling trades, get initial calculations, and then other sections will allow us to adjust our trades with over 20 different exit strategies and get our final post-adjusted trade calculations for each trade and for the total portfolio. There's no other spreadsheet like that in the world. So I'm going to show you just part of that spreadsheet for covered call writing. And you could see here in mode prices was 48.17. You could see the in the money, near the money, and out of the money strikes and the 3 bid prices that we alluded to. Now, the next section of the spreadsheet shows you your initial returns. Have a look where the red arrow is. And you could see the time value returns, because the spreadsheet will deduct intrinsic value for that 45 call, ranges from 4.36% to 7.89%. And spreadsheet will also show us that if taken to expiration, it would be a 33-day trade. And the annualized returns, initial returns, range from 48% to 87%. So those are pretty rich numbers, which tells us that the implied volatility of in mode at the time was fairly significant, fairly substantial, and that's why the premium returns were so high. The spreadsheet will also show us the upside potential if we used out of the money strikes and the downside protection if we used an in the money strike, as well as the exit strategy price points, which is also beyond the scope of this presentation, but part of the material we offer on our website. Now let's define the term portfolio overwriting, which is the topic of this video. What we're looking to do is we're looking to enhance the returns of a buy and hold or long-term portfolio using covered call writing. We want to avoid exercise to prevent any negative capital gain tax consequences. Now this applies mainly to non-sheltered accounts, because if we were trading in an IRA account, for example, self-directed IRA, we wouldn't have any tax concerns. Now, as an example, and this can be tweaked up or down, we're looking to increase our portfolios by 5 to 6% a year, about 0.5% a month. And if we were using weekly options, we would just divide that by 4. We're going to use out of the money strikes, which will allow for those 2 income streams, one from the option premium and the other one from share appreciation. So the deeper out of the money the strike is, the lower the delta is, or the lower the probability of exercise. We'll get into that later in this presentation. Now, there are certain dates that we're going to want to be aware of, perhaps avoid. One is earnings reports, which is not an issue if we're using exchange-traded funds, but stocks do have quarterly earnings report dates that we're going to want to avoid. And how we do that is also part of the material on the website, not part of this presentation. And ex-dividend dates, which is the main reason for early exercise. And even with an ex-dividend date, early exercise is extremely rare. So we also teach how to circumnavigate ex-dividend dates if it's important not to lose the underlying security. Remember, earnings reports, ex-dividend dates rather, are the main reason for early exercise, however, still rare. Now, how are we going to determine what strike to select? Remember, our goal is in this example, 6% annualized return in addition to the dividends and the share appreciation we're already receiving from our long-term buy and hold portfolios. So how are we going to know what strike to select? Remember, we're going out of the money. So an example that we're setting here for 6% would turn into 0.5% a month or 0.1% a week. And the goal in terms of our initial time value return goal range must be stated before we enter a trade. Otherwise, how are we going to know what strike price to select? So we must have determined this before we enter the trade. Now we're only going to use out of the money, which will allow for those two income streams, the premium and share appreciation. And the deeper out of the money we go, that will reduce the risk of exercise and the need for exit strategies if the strike does in fact move from out of the money to in the money, or stated differently, if the price of the stock ends up moving up and away and past that out of the money strike price. Now, we can use delta and implied volatility, which I'm going to show you, as long as the strikes that we select align with our stated initial time value return goal range. In this particular example that I'm giving you today is 6% a year, 0.5% a month, 0.1% a week. We must stay focused on what our strategy goals are, and they must be stated in advance of entering the trades. So what are the advantages of portfolio overwriting? Why should we use it? Well, it allows us to generate a constant, guaranteed monthly or weekly cash flow. It gives us downside protection in bear markets. You know, the market isn't going up, it's staying the same, or it's going down, and yet we still will have generated this dividend-like return when we sell call options. Now, most retail investors are granted this level of trading approval for options, covered call writing. It's usually considered level 0 or 1, whatever the lowest level of trading approval is for our broker, covered call writing is in there. And it can be used as an additional monthly source of income. For years, I was using it to help pay for my son's college and graduate school educations. And now that they're off the books, I just keep reinvesting the cash that I generate from covered call writing and selling cash secured puts. But for whatever your need is, additional monthly income or just reinvesting, whatever it is, those opportunities are available to you. Now, there is no strategy anywhere that has no disadvantages, right? So I'm using a double negative. There are disadvantages to every strategy. So here we go. Early exercise, although rare, may result in tax issues. So you have to watch out for ex-dividend dates, and you have to know how to roll an option if the strike moves from out of the money to in the money. And that's all in the material on our website. Now, for covered call writing in general, share appreciation is limited by the strike price. And that's why with portfolio overwriting, we're going to use call strikes that are very far out of the money. And so that is a disadvantage of all forms of covered call writing. And as with most strategies, there's a learning curve and a modest time commitment. Now, if you're using portfolio overwriting, the time commitment is less than traditional because we already know what stocks we're going to use. Those are the ones that's already in our portfolios. When we're doing traditional covered call writing, our portfolios will turn over frequently, particularly to avoid earnings reports. Now, what happens if the price of the stock moves up exponentially and surpasses that out of the money strike price on or around expiration Friday? What do we do? Well, this is an easy problem to solve. What we do is we roll the option. That means we buy back the current month call option and sell the next month's option. And this has to be done at any time prior to 4 p.m. Eastern Time on expiration Friday. So by rolling that option, our shares will not be sold. Now, we could roll out to the same strike, let's say the April 50 to the May 50, or we could roll out to a higher strike, rolling out and up. An example of that would be the April 50 to the May 55. And that will avoid exercise of our options if the strike price is in the money around expiration 4 p.m. Eastern Time, expiration Friday. Now, I told you there are two dates we have to watch for. The ex-dividend date, which is the most common reason for early exercise, although still rare. And this is a screenshot taken from dividendinvestor.com, which is a reliable free site for dividend information. And you could see, for example, here I used Apple, which has at the time a dividend of 0.63%, small dividend, but nonetheless cash in our pockets. And the X date shows November 4th, 2022. And then you could figure about every 3 months after that. And there's other information, like, for example, Apple gives 4 dividends a year, and it first started generating dividends in 1990. So there's a lot of dividend information on this site, but the main one that we're going to look for is the X date, in this case, November 4th. Now, the site that we use for earnings report dates is earningswhispers.com. There are several other sites. This was one of the more reliable ones, but no guarantees, folks. So this shows for Apple, the next earnings date is January 26th after market close. That's 2023. Okay, so that's where you can find good earnings report information. Now, here are the assumptions when we're using portfolio overwriting for practical application of this strategy. We're assuming now that the shares are in a long-term buy and hold portfolio, and shares are at a low cost basis. We're dealing with non-sheltered accounts, and we're looking to generate higher returns, and at the same time, avoiding exercise. I think the expression is having our cake and eating it too. We could roll options if the strike is in the money by expiration. And we can avoid ex-dividend dates, and there are various ways of doing it, but we can wait for the X date to pass and then write a covered call, or we could write a 2-month option and skip over the month of the ex-dividend date. And that information is detailed in our website information. We can also use weekly options if available to circumnavigate around X dates and as well as earnings dates. Our goal, 5 to 6% a year, and this is a reasonable example. For traditional, we would be looking for more like 2 to 4% a month. That's what I look for. But, depending on your risk tolerance, you might want to go lower, be more conservative. You might want to go higher, be a little more aggressive. So this strategy can be crafted to your specific personal risk tolerance and strategy goals. So there are 3 approaches. I'm going to show you a screenshot in a moment to portfolio overwriting strike selection. Now, all of them must end up with our stated initial time value return goal range, which in the hypothetical I'm giving you here is 6% a year, 0.5% a month, 0.1% a week. We could use delta, which would give us a 90% probability of success, or we could use implied volatility to establish a trading range. I'll show you the BCI expected price movement calculator in a moment. And we could use annualized return goal range, 5 to 6% in this example. So I'm just showing you a screenshot of our blue chip or Dow 30 report taken from February of 22. I just highlighted Dow. It's a lower priced security. You can see that at that time, the 1-month return on Dow was 11.28%, whereas the S&P was minus 0.94%. And in 3 months, the Dow was up 1.59% and the S&P 0.6%. So Dow was beating the S&P in both 1 and 3 month timeframes. So we're going to look at that one. Now this slide here is pretty busy, so I kind of summarized it on the right side. This is an option chain for Dow, which trades on the New York Stock Exchange, was trading at $60.68. So out of the money strikes are going to be higher than current market value. So let's start out where the blue arrows are. We're going to look at the implied volatility of Dow. We're going to use an at-the-money strike. So the closest at-the-money strike to 60.68 is 61. And the option chain shows an implied volatility of 31%. So that means that's an annualized return, and it's based on 1 standard deviation. So we have a spreadsheet, which I'm going to show you in a second, that will convert that annualized return to a return specific for this contract and it will actually be an 84% probability of success. You're going to just have to trust me on that one, even though it's one standard deviation, 68%. Okay, so we know the implied volatility is 31. So if we're going to use IV, we're going to use 31% IV to find the trading range. Now, further down where you see the red arrow, that's the 66 strike, and the 66 strike will give us our 0.5%. So what's 1% of $60 is 6 cents, right? And 0.5% would be 60 cents rather. 0.5% would be 30 cents. So we're going to use the last option premium was sold at 34 cents. We'll use that for the 66 strike. So that's based on the 0.5%. 34 cents we'll use. Now, what about a 10 delta? Well, the 10 delta is the 67 strike. So a little deeper out of the money with a 90% probability of success. So you could see here just from the option chain that we're going to be somewhere in this 66 to 67 strike for this portfolio overwriting strategy. Now you can see I have it summarized on the right side here. So the blue arrows will show we'll use the at the money strike to get the implied volatility. We'll use the 66, which is the high end of the range based on implied volatility, as you'll see in a moment, and we use the negotiated bid of 34 cents. And the 67 strike has that 10 delta, which we'll be using a negotiated bid price of 24 cents, partially between 16 and 36, favoring the market maker a little bit. Now here's our expected trading range calculator, price movement calculator, where we put in the implied volatility of Dow on 2.7. It's about a 1-month return. The expiration was 3/11. And that tells us that in this 33-day trade, the expected price movement is from 66.34, the high, to 55.02. So we're looking for the 66 strike as I showed you before. Now, if we use the 66 strike at the 34 cents I showed you before, the portfolio overwriting calculator will show us a return on an annualized basis of 6.39%, exactly where we want to be. So 66 strike is looking awfully good for this strategy. Now, if we use the 67 deeper out of the money strike, we have a little more protection, but we only get a return of 4.51%. So if that meets our goal, great, we could use the 67 strike. Otherwise, things are pointing to that 66 strike from the basis of implied volatility and the 0.5% a month. If we were going to use the 10 delta with a 90% probability of success, we'd use that 67 strike, which returned 4.51% on an annualized basis. Now, if we want to go closer to the current market value, well, you could see that's greater risk of exercise, but a greater return. Generally speaking, I would focus in on our 66 strike for a 6.39% annualized return based on our stated initial time value return goal range. Let's summarize this, ladies and gentlemen. Portfolio overwriting is a low-risk way of enhancing portfolio value. In non-sheltered accounts, avoiding exercise can be important if the cost basis is low and we want to avoid any negative tax issues. Dividend distribution or ex-dividend dates is the main reason for early exercise. And let me state again, the main disadvantage to covered call writing is that share appreciation is limited by the strike price. So there we have it, ladies and gentlemen. My video on portfolio overwriting, which is a covered call writing like strategy specific for long-term buy and hold portfolios in non-sheltered accounts. Folks, I hope you enjoyed this presentation, and most importantly, I hope it puts cash in your pockets. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.